investing should be looked at like a business and a game plan, not just like, oh, he says I can make money, I'm going to throw it out and make, and then hope it comes back. Hope is the worst investing thesis and way of investing. And like, I can't stress that enough. Hope should be the last thing when you're investing your own hard-earned money.
Yeah.
There should be absolutes and definitives when you're lending.
All right, brother, we are live. How you doing?
I am doing exceptional.
Yeah.
Aside from like, man, he's having little kids. I now get everyone's like, oh, wait till you see all the sicknesses you get and all that stuff. And yeah, no, I'm little Max is, our son's been, they go to daycare. So they pick up all that stuff, bring it home. And you're like, why can't I shake this stuff? Like even my boxing trainer's like, yo, man, why are you so phlegmy all the time? I'm like, man, I tell him my kid just keeps giving me, I just get the remnants of whatever my kids got. It's crazy.
Yeah, they bring everything home. You know what I remember? I was reading this, I was listening to this podcast, and it was called Live Dirty, Eat Clean. And it was just a couple years before COVID. That was when I realized, like, oh yeah, you got to get this stuff in you. And that's what they're doing. They're just getting that stuff in them. They're building up their immune system.
Yep.
And it's so important to do that.
You have to. You don't, actually, I think we all went through this pandemic and realized, all of us have come to realizations of certain things, you know what I mean? Yeah. Like, maybe rubbing dirt on it isn't so bad after all.
Exactly. Well, there's an article that just came out recently now, right? Treated like a flu.
Yeah.
Right?
Oh yeah, that was
Yeah. Anyways, we won't get too deep into that. We're here to talk about mortgages. Cool
if they would have let us know that a little bit earlier, but yes, I agree.
Yeah, exactly. All right, so listen, Brad, I want to talk about a couple of different things. We're going to kind of break them up into a couple of different segments here. The first one, I want to dive into like how investors can get into the market, especially where interest rates are, and some new changes coming down. I think BMO now is actually in that mortgage broker channel. So I'm going to dive into that. I also want to touch on the mistakes that people made. The mistakes people made with where they thought interest rates could, and the market was going to keep going up and interest rates were never going to go up. And what kind of keeps you up at night. And then the third one is just kind of talk about the future, like where you think interest rates are going. And then also you've got this new product coming out, Dave 100. So I want to kind of dive into that. So first, let's talk about BMO, because you've obviously got something new that's happened. That is it a game changer? And how does that kind of shake up the market?
I mean, I think it's, I think for the general public, it might not be like a big deal, but I would say for the mortgage brokers and for the mortgage broker channel, I think for the mortgage industry, I think it's really positive. I mean, so basically to break it down for those that don't know, 20 years ago when I got started in the mortgage business, the only big six bank that wasn't available to mortgage brokers was actually RBC. Okay. So this is actually like, believe it or not, like you go back 20 years and you're like, as a mortgage broker, you had access to, out of the big six, when I include National Bank in that, we only didn't have RBC. That was like the biggest competition for a mortgage broker. And then sadly, BMO exited. BMO was the first of the five that were in there to exit the channel when I got started 20 years ago. Pretty quickly. I think within the first 2 years, BMO was out. With that said, they were not really a big broker lender. They just weren't.
But why did they exit?
You know what? It's generally speaking, it's always a CEO, new change in executive in the C-suite. And some of these guys, they decide to exit. They feel, I think there's always been a thought process. Some of these CEOs and executive types have always felt that maybe the bank can hire their own sales staff and just sell BMO mortgages. So I think every bank is kind of interesting at times. They feel like, hey, we're not penetrating the broker channel very much, so let's switch it up. I think if you're not penetrating the broker channel very much, I think that's because you've got crappy product. That's always kind of what I've thought. But yeah, 20 years ago, BMO was there, our big competition. As a broker, we had access to all these banks, and then RBC was the one we didn't. BMO left the channel fairly shortly after that, and then a big move happened, actually. The number one broker lender at the time was CIBC through an arm that they had called First Line.
Okay.
They were the biggest. If you weren't a broker using First Line, you weren't really a broker. Okay.
Now was that for investors, homeowners?
That was everybody.
It's for everybody.
That was everybody. Yeah, at that time, investor mortgages weren't so hot. You know what I mean? Like, don't get me wrong. It was something that I was focusing on, but it did seem like the market at the time was just not ready for a lot of investors. Yeah. And if you can remember, even, we're kind of getting slightly off topic, but the CMHC had introduced probably after a couple of years that I was a mortgage broker, had introduced a 5% down rental program, believe it or not. So that's to kind of show how little investors, the pool of investors was.
When was that? What year was that?
Oh, that was like 2006, 2000 and maybe 7. It didn't last very long.
Right.
As soon as the 08, 09 kind of US crash came about, a lot of the banks started looking at some of their programs that they thought may put them over. They kind of got scared to see what happened down south, and they're like, let's try to avoid some of these things.
Didn't it get down to 0% as well too?
0% for owner occupied.
Yeah.
So as an investor, it was imagine how crazy this was. You could actually call your bank or your mortgage broker, and you could apply to buy a property, a rental property, with as little as 5% down payment.
So wild.
Right. And that was legit. It was a legitimate product.
Yeah.
And then, of course, for owner occupied, there was the time that you're alluding to that you could actually buy a property with 0% down. It was a straight 100% financing, back insured through CMHC. Right. You had a big CMHC premium on top of it, but who cares? Like at that time, people were like, I'm buying a house with 0 down. And look, affordability was different back then. I mean, I feel like we're talking like back 100 years ago, but the reality is only actually like 12, 13, 14, 15 years ago, you could buy a $300,000 home with regular family income. It was a even detached home in an area maybe in Hamilton or even east in Oshawa or something like that, and you could do it with 0 down and have an affordable payment too.
Yeah, you know what the crazy thing was though is that after you did that 0 down, your mortgage would be higher than what you bought the home for.
Yes, it was.
It was wild.
Yeah, it was. Yeah, it was a product that definitely seemed like it carried some risk, more so for the lenders and the insurers than the borrower. I mean, the borrowers got really very little skin in the game. So as a lender, that's always kind of and we'll talk about that later when we get into the other thing. But as a lender, that's generally speaking a scary thing.
Right.
But to get back to BMO, I mean, so they had exited the channel. Then years later, First Line, the number one broker through CIBC's arm, just exits the channel. New CEO came in and just said, we're going to do this. And so that happened. And then, so now we're down to 3, TD, Scotia, National Bank. And then if you recall, National Bank left the broker channel. So most mortgage brokers for quite some time out of the big 6 banks have only had access to Scotia and TD. Now, granted, those are 2 great lenders to have access to on the broker side.
Right.
I can't say enough about those 2 in terms of, I think they're definitely ones that you want to have as a broker comparative to some of the others. With that said, we're noticing a bit of a resurgence. So what's happened is, as an example, and I think we may have talked about this on a previous show, National Bank. So National Bank, although they don't work with mortgage brokers, there was some really smart people at National Bank through their wealth side that ended up going and making contacts with mortgage brokers that worked with investors, a lot of investors. So if you were a mortgage broker that was working with investors, National Bank through their wealth side would find you if they felt that your customer base fit theirs.
Okay.
And they would open up their mortgage side, but through their wealth side for these brokers. Now, very, very different. There's a whole crazy part about the compensation model. There was no compensation to the broker. So the crappy part is the broker now has to charge a fee to use that. But as a broker, we would really only ever use the National Bank then at that point for their specialty programs that they had that maybe some of the other banks did not. Right. So we would try to use them as seldom as we could, only because who wants, as a broker, I don't want to be working on a deal with my clients with a bank that I have to charge my client a fee. I don't enjoy that. That's never been something I've liked. And you shouldn't do that. If your client's getting an A mortgage, they shouldn't pay a fee.
Right.
But it was, again, a little bit of a weird quasi thing. And this happened about 5 years ago. So pre-COVID, this came to us. So we started getting access to National Bank, which was great. And then now we have BMO back in the channel. So it's kind of, when I say resurgence, I'm saying I started in this business 21 years ago now. 5 of the big 6 we had access to. Then at one point, for quite some time here for the last little bit, we've only had 2. So we went from having, what's the math there on that? I think it's like 83% of the big banks we had access to 20 years ago, down to 33% of the big banks we had access to. Now we're back up to 66.
Okay.
BMO, National Bank, Scotia, TD. The only ones that brokers do not have access to are RBC and CIBC. CIBC has still stayed out of the channel. And RBC, to be fair, has been consistent the entire time I've been a mortgage broker.
Right.
They have just not been in the channel, and they are always a competitor of any mortgage broker. But, listen, competition is good. Competition yields customers getting better rates, getting better products. So I'm all about, competition. And I think there should be banks that aren't in the channel. I really do. I think if you had all the big banks in the channel, I think, what happens is you kind of dilute, You know what I mean? The broker
Right.
channel, and then it becomes a favorites game. I rather it just be who's got the best product, who's got the best rates,
Yeah.
where's the best fit for my client, and that's where we go.
Yeah, that's good for the market, right? Like healthy competition, that's always good, right? Let's kind of dive into like how can some of these investors get into the market? What new products are there out there? I think there's is it MLI? That just came up from CMHC.
Yep.
Explain that a little bit.
So this has actually been quite interesting, and the timing of it is actually fantastic because we have now entered into a realm of high prices and sadly at the same time high interest rates.
Yeah.
And so, look, Gary, when you and I were buying single family rentals 20 years ago, it was a pretty easy conversation, right? I'm going to buy this for this. This is the payment. I can rent it out for this. It's pretty simple.
It's also crazy. Single family homes, cash flowed all day.
Every day of the week.
Yeah. All day.
It was,
you just picked and choose.
It was, when you think back to it, you're like, man, it was like fishing with dynamite. But look, we're in a different realm now. And so, to answer your question, if I'm an investor, I have to stay true to why I'm an investor, which is I want to make money. I want to build wealth. I want to, build equity. I want to see my net worth increase at a substantial pace. To do that by buying a single family home today, it's just not going to work. Right. You and I, we're going to go buy a single family home, which is now going to cost us in certain areas, even good areas, $700,000, $800,000 for a single family home. And then with the mortgage payment and everything else, what am I going to make? I'm probably going to be running a negative. And I think every model that we run on a single family home that's over $600,000, generally speaking, it's going to run a negative.
Yeah.
Right. And so I think, those people that are still employing that model are doing so with a expectation that when rates lower, they will hopefully then lower the rates and then we'll start to make some money off it. But I hate hope as an investment strategy, you know what I mean? And hoping. So I think what's happened is I think a lot of people, and rightly so, have started to look at the math and just go, okay, well, if one unit doesn't work, what's two? And if two units maybe not working great, what's three, four? And so to your point, we've now seen all these programs are opening up. A lot of these bank programs are opening up where traditionally back in the day, as you know, you would call me up before and be like, there's this great deal. I can get a great deal on this 10 unit property. And, 10 years ago, I'd say, Gary, that's great, but we got to go commercial, man. You're going to have to put down like a big 35% down payment, maybe more. You're not going to like the rates. You're not going to like the financing. And you'd kind of shoo away from that. But now there's programs out there where you're getting fantastic rates on these things. Yes, it's a bit convoluted with how it's back insured through CMHC and all this fun stuff. But the reality is there are now more programs for that 16 unit home. Whereas before it was kind of sought out. I was like, a problem child, right? Tough to get financing on. Right. We've now got this new window of a lender and lenders that have found this program backed by CMHC where you can actually buy a property and then convert it to a multi-residential property and get good actually refinance it up to as high as 95%. Like that's wild. It goes against all the rules that you and I are used to. But again, it's specifically for over 4 units. They're looking, a lot of them really like the bigger stuff because that's when the numbers work and that's when CMHC can get behind it.
So is this for like new builds or is this also for properties that are existing where you can go in there and do upgrades, force appreciation? What are the requirements?
So there's actually a ton. It's funny. There's the underwriting guidelines on this thing is insane, right? Meaning there's like all these like even energy efficient models where you're getting there's a point system. I mean, you and I honestly could sit here for about 2 hours and I could show you all the different nuances that it has. And it's actually quite unique and it's quite crazy. But yeah, there's energy efficiency points that you can gain, which will then determine how high of a loan to value that CMHC will insure it for the lenders.
Right.
So there's just a lot of stuff. It's actually its own show. But I found that at the end of the day, whether you're buying a standalone today 16 unit property, or you're going to go buy a single family home with the idea of converting it to a 16 unit property, the financing on that is now so much easier than it would have been even 3-4 years ago, pre-pandemic. Right. It's changed. The one cool thing that the pandemic did do, and I think along with our kind of maybe faltered immigration policies we've had for the last little while, is it's really forced the government and even the lenders, and and I always say government, I also mean through CMHC, to look outside the box. And I would say that this was something that, when you look at traditional ways CMHC has operated, this is definitely outside the box for them. I mean, this is 95% financing up to, potentially up to on a 16 unit property. That was unheard of. If you called me 10 years ago and said, Dave, I want to buy this and I think I'd like to end up with 95%, I'd say, Gary, wrong guy. I can't help you. There's no product for you.
But you know what the good thing though is about this is that as long as I've been in this game, and you as well too, Dave, is that every year when I've gone back and I've taken a look at my newsletters, like, oh my God, there's a new change. Here's a new change. And it's like, you've always got to pivot and adapt.
Yep.
There's always something that you can do in the market that will work, but you just have to, you got to be in contact with the right people. You've got to learn to be creative, but also be smart as well too, when you're doing this stuff, right? But you got to ask the questions, and you got to be having these conversations with the right people in the right industries.
Well, you think about it, even like, let's say you and I are playing a sport.
Mm-hmm.
And we're playing a sport and we realize this one move works great.
Yeah.
So we do the move. And we keep doing the move. We keep doing the move. The problem is, eventually other people on the team and the teams we're playing against are going to see that we keep using this move that works.
Right. And they're studying the tapes.
Exactly. And so, of course, then once that move starts being adopted by everybody, and now I bring it back to the investor angle, we need to adapt and look at different ways. And so you can't just, once you're doing something unique that then everyone else keeps doing, unless you are doing it so much better than everyone else, then you need to start to look for other ways. And I think, that applies to certain things in life. I think that applies to other things, but as it pertains to investing, you need to start looking at what's working and what's not. When we look back at the analogy we just used with a move, well, our move of buying single family homes and renting them out for making a nice profit, and what seemed like a bit of a secret for some time, which made no sense to me, but seemed like we were getting away with highway robbery. Now everyone else, because look, the information flow is such a rapid pace in the world today that everyone is seeing what's been done. And so you need to kind of innovate and come up with new ideas. And so, look, I think the one thing that I will say is that traditionally for quite some time, the banks were very slow to react to changes in the market. I will say that with regards to MLI Select, very, very quick to market. I thought, actually, to be fair, they were ahead of the market.
Yeah.
And that's very rare in bank and business. As you know, it's kind of like an old school,
right?
Things get like, think about, look, Airbnb, right? Very, very interesting. And this goes back to BMO, actually. So this is a great topic to be on with respect to BMO. Airbnb. You call me, last year and say, I want to go buy a property. I'm going to Airbnb it. Guess what I tell you? There's no programs for Airbnb. The banks hate them. Mm-hmm. It's new. The banks don't love new. Right. The banks don't understand how to underwrite new. It goes against short-term rental. It goes against a lot of their underwriting policies. And we had said, I remember Lorenzo and I would always say this. I say, just give it time. One thing I have learned is that it takes a while, but if this thing's going to stick around, which we know short-term rentals sticking around, then the banks will end up figuring out a way. And so now we go back to BMO. BMO enters the broker channel. I'm reading through their underwriting handbook. Guess which bank will actually finance Airbnb short-term rentals? BMO. Now, they're not going to 80%,
right?
But they'll go to 75%. You know what? I think a lot of us, you know what I mean, in the short-term rental game are just happy that a big bank lender is willing to lend on short-term rentals up front. There was this, with certain lenders, it was kind of funny because like you'd be dealing with, a lender on a file and, if it's a short-term rental, the banks would be, even their own people would be trying to give you suggestions to figure out how to get around the fact that it's a short-term rental. And it's like, no, I just want to be upfront. I'm not into the game of deception or anything like that. I want a product where I can go to the bank and say, look, it's a short-term rental. This is it. Here's how my client gets their funds. Here's a report for the funds on it, because you're not going to have a standard lease agreement, right? And so BMO has adopted the program. And I think that's great. And what it'll do, Gary, it's just going to lead to more banks taking on the idea of jumping in. They're not going to let no. And one thing I have noticed in being in this business is that one bank's not going to let the 5 banks aren't going to let the one bank do
You're
well.
going to start seeing Bank of Montreal now making some good money on these Airbnb. Like, hold on a second, let's see what they're doing. Let's kind of mimic it, but maybe put a little different flavor onto it, right? So
that's exactly how it happens.
All right, listen, I want to move on to I think a very important topic here, which has obviously been making some airway in the real estate investing world, is being over leveraged. First mortgage, second mortgage, promissory notes, making decisions based on the fear of missing out. Let's touch on that. Like, I think you've seen what's been happening.
Yeah, I think you're alluding to a case that has presented itself in the public eye, and it's revolved around what appears to be a mortgage broker who specialized in working with investors.
Yep.
I guess getting tied up with the wrong borrowers. I mean, the way I look at it is, this was a situation where a mortgage broker with quite a bit of experience was promoting to other real estate investors this idea of investing up to 100% loan to value on properties that were then going to need work to get done. And then not only that, all to the same borrower group.
Okay.
So, you've got, so I think, look, if I used to have tons of investors that would come to me, or maybe I don't want to call them investors, maybe pretenders. Mm-hmm. I had lots of people contact me over the years, and they'll contact you and they'll say, hey, I'm looking to get into investing. And I say, well, what do you have to invest in? How much do you have to invest? What's I need to know if I'm going to plan this out, I need to know how much I have to. Well, I don't have anything. I'm looking for this creative financing. I keep hearing about that. I hear you can buy investments at 100% financing, and maybe I'm an idiot, but I would just say no. I can't.
Right.
It's not going to work.
And it's because they're hearing this where there's like, oh wow, I can make like 17%, 18%. So these high numbers as opposed to what they're going to get if they go to the bank and get like a GIC or a mutual fund.
Yeah, and I think where the mortgage broker kind of, I think, erred massively is, I mean, you're offering, this ability to lend 100% financing. So let's just run through a number here.
Yeah, let's do this.
The mortgage broker was working for a borrower who says, I want to buy this property in Timmins for $270,000.
Okay.
Now, because the borrower does not have a down payment, because this particular borrower group didn't have any down payment, they were only seeking to get in with no money, and they were going to buy tons of these things, and then they wanted to kind of turn this into this big 600 plus property conglomerate that would eventually make cash,
right? And this is where you hear that whole OPM, other people's money, taken to the next level.
And I hate that. I've always hated that thing. I'm not a big fan of it, because traditionally, look, the banks don't just make these rules because they just threw them out of thin air. They want a 20% down payment because that's the security required for them to feel safe at their lending. And when you're, as a mortgage broker, when you're going to go to people that are your own clients or just random real estate investors and say, hey, I've got this amazing opportunity for you. You can invest on this $270,000 purchase in Timmins. These borrowers are seeking that you give them a $270,000 mortgage. And I, as the mortgage broker, am also then going to arrange, so if you give them the 100% financing, Mr. and Mrs. Smith, I'm then going to arrange a $45,000 promissory note loan to these borrowers that's going to be used exclusively for renovating the home that you've lent the money on. And so once that home is fixed up, it's then going to go from a 270 value, and this is an actual case, by the way. This is an actual true story that I'm explaining to you.
Right.
The mortgage broker says this property is going to go from a 270 value to a $400,000 value. So she's implying that the value of the home is going to increase by 50% by virtue of doing $45,000 in renovations on a property in Timmins, Ontario, which, by the way, has an average sale price of it of about $250,000 anyway.
Right.
So you're this is a lot of speculation. I think what happened was, and I don't know how, but this mortgage broker ended up doing this on a mass scale. These borrowers,
and we're talking like hundreds and hundreds of homes
and hundreds of millions of dollars.
Right. So let's break this down. So that the person now, or the investor in first position, is fairly safe. Will be safe, fairly safe. Not even
at 100% financing. I would say you are crazy. Like,
but the home is worth $270.
Okay, but if they're lending $270,
but they're doing a first mortgage on 80% of that.
No,
or the whole thing.
That's the kicker. This was this.
So there was no first and second and a promissory, or
So picture it just like this: the borrower buys the place for $270, goes to this mortgage broker, and this mortgage broker goes, "Yeah, I'm going to find some random real estate investor who's got money to lend you the entire $270." So it was 100% loan to value. So that goes against every single private mortgage rule that should be out there.
So there was no seconds on those. It was just
I can explain that when I found out about this, there was a couple seconds, but what it was in times where she would pitch to people to lend up to 100%, sometimes the people would only lend 80 or 90. So then in order to get the borrower the complete 100, she would go and source for a second mortgage on that particular property to get up to 100. So imagine if she's looking for funds for these people and the people are willing to lend 100% loan to value, then she didn't need to go and arrange a second. But if you, as an astute investor, said, no, Miss Mortgage Broker, I only want to lend 80% because that's my comfort level, she would then go and find someone, and sadly a sucker, to lend the other 20% so that it's 100%. These borrowers that she was representing, she was doing this and they weren't putting any money in. I need to be very clear on that. No money in.
No money in. So that person that was saying, hey, hold on a second, I'm not doing 100, I'm going to do 80. And they're taking a look at maybe potentially the appraisal, hopefully.
Yep.
They're maybe a little bit more sophisticated. We're like, listen, I ain't giving you the full 100, but I'll give you 80% based on the appraisal.
I would say that that would be a level that I would want to start at, is 80. Like to be fair, I mean, you and I have talked about this a lot in the past, just on a personal level, but 25 years ago, I was taught private lending by who I consider, the private lending guru in Canada, and his name's Terry Wallman. And if you don't know who Terry Wallman is, he is an amazing lawyer. He is considered like the leading power of sale lawyer. So if you're a private lender and you need to get your money out of a home, this is the guy you want to use. He is known as the megalodon. He is the shark of sharks. And so, I was just lucky.
To add to that, Dave, as well too, is that when I started my private lending company back in 2017, I came to you so that I can get your knowledge that you got the knowledge from Terry.
Well,
because it was important to me. Like, I did not want to lose anything of my client's money when I'm doing this.
And Terry's never lost any. And that's the cool part is you make a good point there, is like you wanted to go to someone who's never lost money in the private game. And I was lucky enough to learn from that gentleman. That gentleman, I had a tie to that gentleman through a family friend, and I was able to learn. And one of the key things he taught me, and this is, I'll never forget this till, I'm 6 feet under, and hopefully I don't forget it then. But if you're private lending past 85% loan to value, you are in the danger zone. Okay. And I'm not saying 80% is that much better, but I'll explain to you. And I'm not just making up, he didn't just teach this to me as some arbitrary number. You have to be very careful. If I lend someone money privately on their home and they don't pay me, the only way I can get my money back is by actually going through the legal process of powering that gentleman or female out of the home so that I can then get a realtor in there to sell it and get my money back. It's called a power of sale. It's a legal process that is quite common.
Right.
And so Terry had always taught me, he said, look, you have to understand, as a private lender, if you have to take a home over, there's going to be some costs. That cost is going to be about 10% of whatever that property ends up selling for. You're going to give to the power of sale lawyer. Okay. They're not cheap. A good power of sale lawyer is not cheap. Right. And they didn't go to law school for all that time just to make a couple bucks. Okay.
Right.
They're sharks. Okay. You need to understand that power of sale lawyers, for the most part, are swimming in different waters than the rest of us.
And that's a good point, because a lot of people don't know what is the cost to sell that property.
Nobody does.
10%.
Well, it's 10% just to the power of sale lawyer. Then what's it cost? Because you have to understand, power of sale is different. As a lender, if I have a property that I have money into that's now gone into power of sale, there's all kinds of things that could be happening. I could now have to start paying for their home insurance. I might not have to start paying for if I've lent a second mortgage, I have to pay for the first mortgage to make sure it doesn't go in arrears so that I control the power of sale. So you have to understand is you don't want this thing not selling quickly. You're going to need to sell quickly. And generally speaking, with power of sale, you're going to want to get the most active real estate agent in that area who's doing all the marketing, who's the big dog in that area. You got to get them on this property. Guess what they cost? 4 or 5%, right?
Yeah.
Like you're in the game, you know how about. So now how much then add that up? I got 10% to the power of sale lawyer and I got 4 or 5% going to the realtor who has to sell this.
Right.
That's 15%. So to go back to the math, if Terry's saying don't lend past 85%, he's saying that because 15% of the sale of that home is going gonzo. So if you're lent past 85, you have to understand if this thing goes bad, you're already losing money.
Right.
Some of your investment is going to be gone.
Now you also then got to worry about, is the market going down?
Thank you.
Then you've also got to worry about, hey, they haven't paid me in 3 or 4 or 5 months.
Yep.
So now you got those 2 other factors as well.
So then to your point, do you go to 85%? You got to be careful. Listen, 85 is the red zone. That's when you hit 85%, that's when your revs are in the red. Your engine can blow anytime.
Right.
Okay. Does that mean I want to go right to just the tick before the red? No, I mean, maybe, but like I'm going to have to make a decision on that empirically. I'm going to have to really look at that file to decide. And so now other things come into play. You know, I always say 85% is the bench of the red zone. You know, now let's look at it. Now I'm going to look at the deal and go, okay, you know what? I don't like that income. I don't like the property's not maybe the best property in the neighborhood. So now I start going, instead of 85, I'm going to go to 80 or I'm going to go to 75. You know, I was looked at, during the pandemic. I remember being at a real estate Zoom meeting where it was talking about private lending.
Yep.
And I was being told that I was the conservative one, that of the panelists up there, I was some crazy guy because I thought it was insane that people were lending 95% loan to value on second mortgages. And you know what the best part was? And this is what I always laugh at. When I would say to them, look, guys, what makes you think that if it costs this much to power of sale people out and sell the home? And they'd say, well, Dave, we've never lost money yet. So it was like this confirmation bias. They were like, well, I haven't lost money yet, so it works. Well, that's the stupidest investment idea I've ever heard in my life. I haven't lost money yet, so it works. Well, what happens if something comes up? To your point, value goes down in the market, right? You're at 95%. We already know you're at the red zone. So what happened to that guy who lent someone based on a 95% mortgage? The values of the homes have come down and interest rates have gone up, and now that person can't pay. Well, guess what? They're going to lose money because when they take over that home and they resell it through power of sale, they're going to lose some of their initial investment. And as a private lender, like if you lose money as a private lender, I'm sorry, but there are so many of us out there that aren't because we're using healthy decision making. I just think it's really, really, really crazy to lend into areas on a home, loan to value areas where you know that if something goes bad, you will lose. I just think that's like a terrible investment thesis.
Yeah.
I want to lend money where I can look at it and go, well, if they don't pay me and I got to power it out, I'm still safe. That is a real private mortgage lending decision and a smart decision. But the idea of I'm going to lend to 95% because it's worked for me in the past is a terrible idea.
Yeah. Well, listen, a lot of people have learned that in the last, few months that is not the right way to do things. Now let's move back into that promissory note.
Yeah. Danger.
Okay. So then now they've lent up to 100% loan to value, whether it's a full first or whether it's a second maybe in there. When does that promissory note come in? Is that after the fact?
Well, the crazy part is this mortgage broker was already arranging it at the time of arranging the mortgages.
Okay.
So it was actually arranged so that when the mortgage closes on the property and the purchase closes and everything for that 100%, then the next day or a week later, she would have a new lender, a different lender now lending these borrowers who, again, have put in no skin in the game, lending these borrowers $45,000 for renovations. And here's the kick. And this is
which was the promissory note,
which is done by a promissory note. And as you and I know, how good is a promissory note?
It's a promise.
It's
not even that.
Its value it would be comparable to toilet paper, I would say. You know what I mean? In the terms of legally, its value. I mean, certainly, and when someone might say, well, no, you're wrong. You can take it to small claims court. I'm not denying that. But what I am saying is if that promissory note, the $45,000, was lent on top of 100% financing on a property, and it's not even registered, the promissory note's not registered, where are you getting the money? Like if these people, and let's just play this out. So I'm the borrower. I've now closed on a home where I've put no money in. I got 100% financing. And now I just got a check for 45 grand. Okay. Technically, couldn't I just take that 45 grand, go to Vegas? You know what I mean? And if I get lucky, I get lucky. If I don't, I don't. Because at the end of the day, that 45,000, if I get powered out of this property, that 45,000, I'm never gonna have to pay that. That's gone. It's gone. It's not even registered. It's literally not even registered. It's a promise that these people will pay back. And so this story gets crazy because when you think about it,
Crazier than this?
oh, it's insane. Because guess this supposed the renovations that were supposed to be done with the 45 grand.
Right.
Okay. Guess who owned the company that was going to do the renovations? One of the borrowers.
No way.
It was a scam. It was like a scam. So it's gonna all come out. Don't get me wrong. This is gonna all of what happened. The reason this got tons of public press, okay, is because in order for these people, basically these borrowers, they're done. They're finished. They can't pay. The money's gone. I guarantee you, it's been spent on some very lavish things. You know, there's YouTube videos out showing the borrowers living an insane life.
Yep.
Not looking the same way as some of these properties. Some of these properties are derelict. They're done. There's not even tenants in them. These people have just up and kind of left these borrowers. So now it turns out that the wife or one of the people tied to one of the wives was the one running the supposed renovation company. That money is gone. I mean, these people, the only reason it became public is because they had to file a public motion to try to get a stay on their debts, effectively to allow them time to try to restructure their companies, which you and I know is just going through the process. They're not really trying to restructure anything. It just bought them time to try to maneuver like ants and run around and scurry away and maybe find where they're going to go. But at the end of the day, this is going to play out over the next 1 or 2 years, and it's going to be a horrid story for small communities such as Timmins, Sault Ste. Marie. These, I'll call them idiot. They're idiot. These idiot borrowers went and started purchasing like 200 units in Timmins. You got to understand, 200 units in Toronto, no big deal because there's a lot of people.
But when you're in a small town like Timmins, yeah, that's an impact.
They're going to have this is going to have a massive negative impact on these small communities, like absolutely. Like, and it's not just the people that can't get it, that the house now is not able to be rented because it's all screwed up. It's all the trades, all the people. Like if there were people in those homes, then stores around the area would be getting more business. These people have bought all these homes. Half of them aren't even filled now.
And they're vacant.
And it's vacant. And that destroys communities. You ever want to figure out how you get ghost towns in the States? Look what happens when you mess with the infrastructure within those small communities. It can be damaging so quick and so fast.
Yeah, I don't think people see or even understand that, right? Yeah, I think you really did a good job breaking it down there. And then how do you see this playing out now? Do you see a larger company coming in and just buying this whole portfolio? Yeah. Okay.
They've already been. So there was a company already came in and so these borrowers, they obviously got a little hot under their collar for a while. And so pre the press picking this up, they had already sold a basket of the properties, probably the ones that already had tenants in them. Like, a big company's not going to go buy the piece, the ones that are
so
in
they're
trouble.
going to pick and choose the ones that they want.
Why didn't they buy all 600? You know what I mean? They only picked like 200. So
right. And when they buy these 200, what is it? Like 60 cents on the dollar? What are you thinking?
It's a great deal for the buyer for sure. Yeah. The big companies are, they're not, some of these have boards of directors. These are the decisions being made by some of these big companies, through the REITs and everything else. I mean, this is high level decision making. Right. And so, yeah, I think they're going to look at these guys, these borrowers as a bunch of idiot borrowers that did this stupid thing. Somehow they found a mortgage broker naive enough to, jump on board and put her own career at risk, which I think is just so silly. And the people that'll get hurt are going to be the lenders, are going to be the promissory note people, are going to be the people in these communities, and meanwhile, the borrowers, I mean, again, we're not naming names, but you can go look this thing up, and these guys they're trash. They're, it's that money, all that promissory note money, which I think is to the tune of $54 million. That was spent financing some of their other companies that are terribly run companies as well. They have like the one guy has like an MMA like website, which I'm sure a ton of that promissory note money was going and funding, paying some of these UFC fighters to do interviews with them. I mean, even see some of the videos. He does these videos to one of the main borrowers who likes it. He's like the mouthpiece. He does all these videos. He puts up all these videos of him with like Rick Ross and like this and that. But then when you watch the video, you actually realize Rick Ross is just sitting there while this guy talks, and Rick Ross will be like, yeah, good job. You know what I mean? He doesn't say anything because these guys are just paying Rick Ross for 10 minutes of his time to stand out front Rick Ross's house, take a couple videos, Rick Ross say, yeah, good job, da-da-da. Yeah, you're the man, whatever your name is. And that's it. And it's literally like...
and then Rick Ross gets like 20K or 50K or whatever.
And Rick Ross is happy to take his $25,000 and for 10 minutes of work. You know what I mean? And so, but these guys, they prayed, and it's funny, the mortgage broker bought into all that because clearly, if you're a mortgage broker, why would you help a group of like 4 borrowers who have bankruptcy issues in the past, didn't even have like great credit, don't have really sustainable, stable income. You know what I mean? And you're going to help these people go buy 600 homes at 100% financing and then arrange some promissory notes. Like we take, as mortgage brokers, we have to take courses every year to keep up with our continuing education. And believe it or not, one of the courses we have to pass is respect to private mortgages. And this is talked about in the, like everything this mortgage broker did goes against every single rule that they try to teach you. Do not ever put, your own client's money into a borrowing situation where you're lending past limits that you shouldn't be. Don't ever look to arrange promissory notes for a borrower. You know what I mean? And the other thing too is like, there's all kinds of like disclosure issues here. Like how much do we know was she really disclosing to the people for the promissory notes that these borrowers had 100% financing on the home? Because that's going to help. That's something I need to know. If you're asking me to lend you money on based on this project you're doing, I need to know how much is owing on the home. Like how much do we think that those promissory notes were really fully disclosed to the lenders? Like there's a whole thing coming up. And sadly, you know what? As mortgage brokers, we have errors and omissions insurance. I think the saddest part is it's very possible that whatever losses end up being occurred, these people will sue the mortgage broker. The mortgage broker will end up having errors and omissions insurance and potentially not have any repercussions other than possibly maybe losing her license. And who knows if that, I mean,
and you're probably going to see new regulations come down now as well too from this.
Well, it makes us all look bad. It makes, it's a standard thing, right? I mean, there's how many mortgage brokers, and then you take 1 or 2 of them to do just really foolish stuff and the press to pick up on it, and it ends up kind of giving us all a bad name. So I think sadly we're going to end up as mortgage brokers, because this isn't the end of this story. No. This is actually the beginning.
And I bet you're also going to probably see even more stuff come out this year, not only for this, but also other things that are still probably brewing in the background because they're like, hey, well, look, this makes sense. The market can't come down. And I bet you're going to start seeing that tide go out now, and you're going to start seeing a lot of things come out into the marketplace, right? So sad. And you know what the sad part is? It's the investor who wanted to get into it in the fear of missing out, and now their 100,000 or 200,000 is gone.
Yeah. I mean, look, there is a high probability that some of these lenders that were lending at 100% loan to value on specific properties may lose 50% of their investment, once this is all said and done, maybe more.
Yeah.
I mean, once you get lawyers,
that's the thing. When you get lawyers and all that involved.
There's corporate bankruptcy lawyers now involved this. You don't think they're taking piece, and they get paid first, these guys, you know what I mean? That's the other thing too. Like it's a mess and it's sad. And, but it should be a lesson. And I think the cool thing is for me as a mortgage broker, I took it, even though it didn't negatively impact me and my business, I looked at it as like, hey, stick to your laurels, man. Like, you know what? I got laughed at, you know what I mean? On a Zoom call, like I said, during the pandemic, because I was the only one up on that panel out of all the, mortgage brokers and lenders that said, no, I don't go past certain loan to values. I didn't care that the market was hot. That was the thing. People were like, well, don't you care that the market's so hot? The value is going to be worth so much more in like another year. So your loan to value is better. And I'd say, speculation, man. That's a dream. Like, I'm not saying that the values aren't going up. I'm not denying that, but I'm saying what happens if there's a change. You can't just look at investing with one camera. Like, you have to look at it in multiple lenses to see, there's your entry, there's your exit, there's the middle. Like, investing should be looked at like a business and a game plan, not just like, oh, he says I can make money, I'm going to throw it out and make, and then hope it comes back. Hope is the worst investing thesis and way of investing. And like, I can't stress that enough. Hope should be the last thing when you're investing your own hard-earned money. Yeah. There should be absolutes and definitives when you're lending.
Yeah. And listen, man, this is not a get-rich-quick game. It's never been. It's just it's a slow game. Yep. You'll make the money over time. Listen, Dave, I haven't invested since 2020. This year, for the first time, I'm excited now to get back into it because there's a laneway now. Yep. I can negotiate. I could knock the price down. I can go back and forth. I can put conditions in. That's what you want. It's not a fear of missing out. It's just, do the numbers make sense? Yep. And that's all it comes down to. All right, listen, I think we beat that one up pretty good. Let's move on to the last segment here. Yeah. The future. Where do you see things going from an interest standpoint? Do we see any rate cuts happening this year? Do we see potentially maybe even going up if inflation starts to pick back up again? And then also I want to dive into your Dave 100 as well too. So what are some of your predictions?
Well, look, Bank of Canada, we're ripe for some decreases this year. Obviously the big question is when, and you bring up a point, what about inflation? So, let's attack that from a couple different ways. If we can continue to see the current trend with inflation, slow upticks, slow downticks, sorry, I shouldn't say upticks, slow downticks. Eventually, Bank of Canada has said their target is 2.5% by the summer, sometime in the summer. And that then they believe that they will achieve their target of 2% inflation by sometime in 2025. So based on that, you want to look at it and say, okay, when should the Bank of Canada start reducing? Generally speaking, they are not going to wait until it gets to 2% to start lowering. That means we're likely going to hit some deflationary periods until it flips around. So the reality is, I think you start to get some small, just little tastes to change some of the sentiment. And I think that starts in June, July, or September. Now, again, we got another 3-4 months of inflation data, Bank of Canada meetings. But look, I think June, July, September is when you get that first cut. I think the cut is maybe 0.25%. I don't think it's gonna be anything big, maybe 0.5%, but that would be it. That would be at the max, and I don't think that's very likely.
And 0.5% would be if something broke.
Yeah, I really think 0.5% would be too much, but I think it's a possibility. Okay. But I think 0.25% is the likely scenario.
Okay, so that's a combination of inflation continuing to move downward, and then also, what about some of these mortgages that are coming up for renewal? Do you think that plays into it as well too, or is that more 2025?
Well, look, the Bank of Canada is going to tell you that they don't look at any of that when they're determining interest rates. But obviously, you and I can agree there's probably some political wins about, look, we're already seeing, like, even on my drive here, I'm watching, I think it was like the health minister blaming, the health minister talking about housing and blaming it on the Bank of Canada. Listen, politics is now, we got an election coming up potentially in this country in a year and a half. Right. So we are now getting into that political storm. Could you see the Bank of Canada being under a bit of political, stress or whatnot, and them making moves a little quicker, potentially?
Right. And the Bank of Canada is not even supposed to be political.
They're not supposed to be
at all. Kind of like the Fed, right? Yeah, it's supposed to work outside of that. However, what you're saying is,
well, yeah, we seem to have like a bit of a pissing match going on. If you notice, like the Bank of Canada, I think at the January meeting it was actually started saying like that, basically in a nice way, saying that the government spending is very tough on their battle against inflation. And then as soon as we got the 2.9 print that came out in February, for January, so remember, it's always a month behind, but the February print that came out for January, we saw 2.9, which is actually, believe it or not, the second lowest CPI print we've had in Canada since April of 2021.
Okay.
All of a sudden, Justin Trudeau, who claims to, as we all famously know, he claimed to not care about monetary policy, right? Many years ago, all of a sudden is saying in a press conference that, well, since inflation has come down to 2.9, he thinks the Bank of Canada should start to look at lowering rates. So you even have basically you have the Bank of Canada saying, government, you guys are spending too much. It's making our job hard. And then you have the government going, well, inflation is looking good. We think you should lower it. Government. Trudeau should have nothing to do with that.
Right.
Freeland should have nothing to do with that. Likewise, the Bank of Canada should have nothing to do with politics. But we are in a new era where these things are intermingled. And so, look, I think if you're kind of like a theory guy and say, look, election coming up, the Liberal government will probably, based on how the polls are looking, they're probably going to want not so much stress on them with respect to housing affordability. So wouldn't it be pretty convenient that by next summer, interest rates are down potentially like 1% to 2%, and now maybe it's not such a hot button topic and it becomes less of an issue for the Liberals? Because I think the Conservatives got them pretty bang on that particular subject. I think it's pretty obvious. So I think Liberals are going to try to do everything to try to negate some of that advantage.
For sure. And the other thing with it as well, too, with the interest rates being where they are, is the housing starts.
Yes.
That's a big issue.
Rough.
Right? Because they're just not where they need to be.
Well, and it's you bring up an amazing point. The only thing is that's not going to be an issue today anyways. It's crazy, but that's going to be an issue in 2-3 years.
Right.
That's going to be a big issue. Like
massive.
Yeah. And I think that's why you have a lot of people, and maybe rightly so. I think time is going to tell, but you have a lot of people that are, kind of jumping in on a little speculative play, being like, look, housing is a big, big asset over the next 4 years here in Canada, because immigration is still high, even though they're pumping the number down from millions and hopefully getting down to their target of 500,000. 500,000 is still high for us, for our country.
That's a shitload of people.
It is.
Yeah.
Well, when you compare it percentage wise, when you compare it,
and where they're landing, that's the bigger point. It's either here in Toronto or down in Vancouver. And my concern really is, and I don't know if you think this as well, it's not a crash down; it's a crash up.
Yeah, it's melt up. Yeah,
right.
I'm scared of that too. I think I am scared of that, because I think the problem with melt ups and values is that obviously it makes affordability that's a problem we're trying to tackle now, and it makes it worse. But also it makes for the eventual, crash. It makes it that much tougher. And I'm scared that our real estate cycles are shortening. And, the problem with real estate cycles shortening from that classic, 20 good years and 3, 4, or 5 bad years is that it starts to become more volatile. And I think the cool part about housing was that it was like the less value. It was kind of like you said earlier, it was the constant. You're just going to kind of chip away and invest and make some money. And the problem is a higher level of volatility with respect to pricing and affordability in houses makes it less of that easy bet. And it becomes, I don't want to say like a stock, but it starts playing a lot different. You know what I mean? Right. It becomes, and the problem is when you have that is you have fast money enter the fray. And I think we can all agree. We all know someone, everyone listening to this knows someone that during the pandemic had someone that was like, I'm going to get into flips. I'm going to make some quick money. We call that fast money in my business. So that's fast money. Fast money doesn't stick. Fast money gets in and then they get out, and then they go take their money and they put it in something else that's seeming to make money. That's not sustainable investment money into our country. And to be fair, they're just coming in, putting some, window dressing on a property and then reselling it in a hot market for a pretty penny, and all the power to them. I'm all for capitalism, but I also think, when we're in a country right now that's not producing the supply of homes that is needed to house the people, and then you have other people playing fast money in real estate, I think it's a recipe for disaster, sadly, right? But
yeah.
It is what it is.
And the one thing that I've shifted doing over the last, we'll say maybe 6 months. Yeah, look, I still love working with real estate investors, but I don't know if you've noticed even on my social media, I'm focusing now even to help first-time home buyers get in, because I really truly feel there's this very small window now, and teaching them how to get into it. It's not their forever home, convert that property or find something that's got 2 kitchens in there and supplement the expenses, right?
You're bang on. I think, look, when you look at the last 10 years and you look at the concentration of, let's say, or the percentage of files that investors would have done compared to, I call it regular clientele, people that are just buying a home for themselves, or refinancing a home for themselves, it's definitely going to be less. There are going to be per capita, less investors, active investors over the next 5-year period. Let's say, I don't want to say 10-year period because there's a lot to cover in 10 years, but over the next 5-year period, you're going to see more end users at the properties. And an end user is going to be someone who's actually buying the home to live in the home. Right. You will, and it's not necessarily because the investors aren't out there. It's simply because you and I know that the investor world is different. The single family home, the duplex is not as investable anymore. So the fact that those properties now will have less investors lining up to buy them means that you're going to have more regular buyers looking to buy them. And you're going to end up having more investors focusing on the multis, the 4 units, the 5 units, helping people with laneway housing, helping people turn their home. There's going to be a big market for people that can coach people and show them how to take a 1 unit home and turn it into a 4.
And you know what, Dave? And that's a good thing, because even when I first started investing in real estate, it was a small market.
Yes.
Real estate investors has always been small. It's only over the last 3 years where it just got so crowded. And I'm
frothy.
like, who is this person? Who is this guru? Who is that one? Like they were just coming out of the woodworks. It was crazy. And all of a sudden they left their cubicle. They're in this game. They thought it was easy, and now they're back at the cubicle. And this is a healthy thing that's happened. Unfortunately, people got hurt and they got burned, but this is healthy because it should be that frothy. And that's why I think you heard a lot of first-time home buyers screaming and crying, and they're like, "This is unfair. There's too many investors in there." True.
They were right.
True.
Yeah.
I agree 100%.
Yeah. And hopefully this gets us to more of a rebalancing. I think that's, I hate when real estate is like the big, topic. It's the big investment thing. It's the newest investment thing. I'm going to get in investing in real estate. I don't love that, because it's real estate investing should be for the long term. It should be for the patient investor. It always has been thought of as it's a long term. It's set it and forget it. You know what I mean?
Right.
I'm not a big fan of housing being used like a stock, or invested in like a stock and fast money and whatnot. And I understand the market is going to do its thing, and those people will make their money when they can, and they'll lose their money when they as well can. But I just think, again, I always go back to the fact that we have an issue here in our country, and we have an issue. We do not have enough homes. We 100%. Do not have enough homes. And the problem is that is causing pricing to go up. Not naturally, though. I want to be clear on this. We have hit an immigration level that was not a natural level. And, we all know that we're spending a bit more time in traffic. We all know that, we're having to see some of our friends and family members and people we know having to live in a home with another family, within their family. It's, 2 households living in one now. We're all seeing it. And I just think that, when you have, I think that there should be, I don't want to say restrictions, because I am a pretty much free market guy, but I just think that we have a humanitarian issue here where we need to concentrate on getting the homes built, and then the market will balance itself out with respect to price. But I just think right now it's not a natural balance, because the fact that we have more people coming in than we have homes being built is making a home a very, very hot commodity. And the problem is then that dictates the price. And I just think that's, the only reason why some of these values of these homes are super high is simply because the knowledge that more and more people are coming to this country and the homes are being built, that's what's causing that, a supply-demand issue.
Right.
But I feel like if you can get the supply-demand issue back to a balanced issue, I think then we can really look at, okay, where are we at with price? Because right now we don't know what the true value of anything is, simply because we have this massive imbalance of supply and demand on housing.
No, I agree. Let's wrap it up with this. So you're doing something new this year, Dave 100.
Yeah.
Get into that.
Dave Butler 100. So it's actually a cool little thing. You know what? I've been so lucky in this business. I've been doing this for now 21 years. I've experienced and been so thankful to have a level of success. My main company, that I have run is, been very much predominantly geared towards real estate investors. So, if you're looking for, a mortgage for an investment property, we were kind of like the people you would contact, and that was our specialty.
Right.
You know what though? That company is now doing its thing. It's doing well. I've been very much lucky to kind of now manage it from above, and I've taken myself out. As you know, sales can get a little crazy after many, many years, and you like to look at different hats to put on your organization. But
yeah, I don't know if people know this, but I think I need to say this, is that you were one of the hardest working mortgage brokers. I would say even somebody that I knew.
Thank you.
Honestly, because man, you'd be up to 3, 4, 5 in the morning doing what you got to do to get this thing going, and you've done an incredible job. And it's glad to see where you are and that you've been able to take a step back and have such a great team to service your clients.
Well, no, thank you. You know what? Listen, 9 a.m. to 4 a.m. is not a great shift. It's not the fun shift, but it is the shift that if you're willing to put that shift in your 20s and your portions of your 30s, I think you can get ahead of a lot of your peers. And that was kind of a mindset. I knew I'm not the smartest guy, but I thought I could outwork some of the people that I was going up against. So that was always a big thing. But I think recently I've been able to do an appraisal of my time. And I wanted to sit there and figure out how can I give back? It's tough. The real estate investment mortgage world is a tough world because, as you know, banks are offering different rates for rentals, or usually higher rates than the regular owner occupied rates. And not only that, working on investor files, although I love doing it, those are thick files. And by thick, I mean, when you got a client come to you and they got 10 rental properties already, that's a difficult file to work on. You're going to have to collect 10 mortgage statements, 10 property. You got to do a lot of, analysis. There's just a lot of work on those. So I looked at my time and I said, look, aside from running my businesses that I have, I believe I have a certain amount of hours in the day where I will be able to help 100 Canadians this year get the lowest possible rate on their owner-occupied home. And that means I'm going to be using my commission that I get to buy down the rate. Whatever that bank will allow me to buy it down, I'm going to buy it down. I'm not doing this at all for any type of income. This is not an income thing for me. This is me trying to figure out a way I can save 100 Canadians $1 million total. And I did the math, and if I can save 100 Canadians $10,000 each by getting them a lower rate on their owner-occupied home, I could take $1 million then out of the bank's pocket and put it into our clients. And look, that's not a lot of money. I mean, compared to these companies are making billions of dollars, but it's a start. And I think there's going to be more and more people that are going to need this. We are in a time where saving a 0.2 on your interest rate is going to have a massive effect on your family's income and your family's expenses. So I thought, look, let's give back a bit. It's a cool thing. So I got a buddy of mine within some of my other companies. There's a group of us, 1 or 2 of us, that are going to work on this, and we're going to put some time in after hours or during hours. But this is going to be in addition to what we normally do. But yeah, I think we figured we could probably do about 8-9 families a month, so about 100 per year. And yeah, it's just to give back, man. This is my cool thing after 20 years to be like, okay, you know what? We're not going to make any money on these files. We're just going to buy the rates down with whatever we're getting from the bank, and you're going to end up with the lowest rate possible. Can't do it for everybody. Don't have the time to do it for everybody, but there's 100 people, 100 families we think we can do this for on a yearly basis, and hopefully it grows. I want to see how this thing goes. You know what I mean?
Awesome. I love that. I really do. And so you know what? I think we should work together on this, Dave, because even for me as well, too, like I've brought on 3 new agents on my team, and their focus is to help homeowners get into the market. Yeah. Like, again, yes, the investors are there. We're going to continue to keep servicing them. But to me, I feel like I want to give back. I want to actually help families get into the market, because I really do feel like there's a small window, especially if they want to be in that Toronto area or in that GTA area close to, I think probably one of the best cities in the world.
Well, look, you and I could say at the end of the day, it might sound corny, but you and I have been very, very blessed and lucky working in the mortgage and real estate business for the last long time that we've been doing it. I think, and maybe it's just because I'm getting older, maybe it's because I have a kid now. Yeah. But I'm like, I just want to return some of, there's been a lot of goodwill that clients have, has come to me from my clients over the last year, of the last 20 some years. This is just a cool thing to give back. And to your point, we have made, our families have been very thankful and lucky that we've been in this industry. So we have been able to do something to help our families. This would be a cool thing to help other families. So again, I know it's corny and whatever it is, but these banks every quarter, they're reporting billions and billions of dollars of profit. I mean, if we could just get a bunch of people looking at, collectively trying to save their clients some money, take some of that money out of the bank's pocket. First of all, I don't think the bank's going to notice it, but I think our families that are saving the money are going to notice it.
Yeah, listen, I don't think it's corny at all. I've actually gone back to actually teaching classes. I did it with one of my agents where we can show them how to actually cut their mortgage payments in half.
Love it.
Dave, I'm telling you, it was such a good feeling.
Yep.
I felt good because they were genuinely, they had no idea because they're new to this. Like, what? We can cut our mortgage payments in half. You can put somebody down in the basement and I can be living upstairs. This is not my forever home. And it feels really good to be able to help them through this, guide them through it. And so I don't think there's anything corny about it. I think it's one of the best things that we can do with what we've learned over the years. And I think we should do it together, brother.
Hey,
I think
I'm with you, man.
Yeah.
Maybe it's just us getting older and it feels corny, but I mean, maybe in our 20s we wouldn't have done this, but it just feels right. It just feels right. Something to do. Something also for maybe my kid down the road to be like, hey, my dad saved people lots of money, man. So yeah, just something extra to kind of get in there. And listen, I got the time. My kid's about to get into daycare almost full time soon. So it's like I said to my wife, all right, I'm going to have to do something with this extra time. And let's see if we can save some Canadians some money.
Let's do it. You let me know whatever you need on my side to help you through that as well too, brother.
Done.
We're in.
Hey, any of your clients need any help, man, we'll be the first to, it. At the end of the day, they're going to get the rate will be bought down. We will do everything we can to make sure that they close with the best rate that they can find on the street.
All right. So listen, if you guys are listening, and you should be, reach out to me. I'm going to get you in touch with the man, Dave. Dave, listen, man, I've enjoyed doing this with you. I always enjoy having you here, man. You're a lot of fun. I've been a good friend to me and also an incredible mentor as well, too. I've learned so much from you. So thank you because of the mentors that you've had in your life as well, too.
Hey, listen, you're a sponge, man. Every time I come here, even before the show we talk, you're teaching me stuff that you've been doing. So, I mean, I will say this, you guys are doing great over here, and I'm seeing the growth that you guys, with your company, it's very evident what you're doing, man, and I really applaud it. I think you guys are doing great, and I know I talked to Zanzini the other day, and he was telling me how you guys are just killing it, man. So, yeah, all props to you guys. Great success story that you guys got here.
Thanks, man. I appreciate it. If people want to get in touch with you, what's the best way?
Email is good. I'm Dave at DaveButler.ca, so that's a pretty easy one, and we will have the website up very shortly. We're just actually getting all the final touches on the Dave Butler 100 marketing and whatnot, so we'll have that up in April, so I'll be DaveButler.ca.
All right, awesome. All right, Dave,
Beauty.
Thanks, brother. Appreciate it.